Hello and welcome to this presentation on tackling your tax return. Completing a tax return can be a daunting and stressful experience for many. We decided at Proactive Resolutions to put together a short presentation to help make the experience less painful for you. If after viewing the presentation you feel your stress levels remain high, then please contact us to see if we can help. Now in this presentation we're going to cover a few key points. We're going to look at who actually needs to complete an individual tax return. Doesn't apply to all individuals. We're going to consider the key information that we need to get our hands on in order to complete the return. If you're a business, what you can actually claim for in your tax return, and some of the key dates, and also that wonderful moment when it comes to paying the tax. We will be focusing on self-assessment tax returns for the year 2017 to 2018. This tax return will include income and any capital gains transactions that are assessable for the period that covers the 6th of April 2017 up to and including 5th of April 2018. Income typically will include business profits, salaries, benefits in kind, rental income and dividends from companies. One key consideration is who the self-assessment tax regime actually covers and who needs to bother to complete one. The main situations where a tax return is normally required is if at any point during 17-18 you've been self-employed and your income has exceeded £1,000. If you're classified as a higher paid employee, effectively where your gross income is in excess of £45,000 and you've also received what's called untaxed income. If you've been a company director, unless it's for a not-for-profit organisation and you didn't receive any financial benefits in that period, then it also applies to you. If you're classified as a higher earner or your partner is a higher earner and you are receiving child benefit in that period of time. A higher earner in this context, by the way, is if either you or your partner has income exceeding £50,000. If you wish to claim loss relief in that period of time, then you also have to complete a tax return to qualify. Now the tax return, as we mentioned earlier on, not only just covers income, but it also covers capital transactions. So for example, if you've sold shares or investment properties or equivalent and it generates a chargeable gain, then you have to complete a tax return accordingly. Now, on the assumption that the completion of the tax return does apply, we need to consider what the document itself includes. And this will be the same whether it's an online or a paper return. Now, there are two parts of the tax return, something called the core return, and additional pages referred to as supplementary pages. Now, the core return is information that applies to everybody, irrespective where their income comes from. And this is where we fill in our personal details such as our tax reference, normally shortened to something called a UTR, our name, our date of birth, typically national insurance number. Within this core return, we will also provide details of any income we have from savings, pensions, pension payments made, gift aid claims, and any allowance claims that we wish to make. The supplementary pages are used to record details if, for example, we're an employee or a company director. There's a set of pages to cover your self-employment, business partnerships, income from property, foreign income or gains, any capital gains transactions, or if we are claiming to be non-UK resident or dual citizenship or dual residency. Now again, for me, preparation is a key thing here to actually keep the process as straightforward as possible. So gather the information at the beginning, and it certainly will make life easier once we get that. A critical piece of information is to make sure we've got our unique tax reference called the UTR. It's a 10-digit code unique to each taxpayer, and normally we would not be able to submit the return without one. If you can't find it, by the way, have a look to see if there's any HMRC correspondence that has that number. In a worst case scenario, call HMRC and get the code reissued to you. Additional supporting documentation would be useful. So if you are an employee, part-time or full-time, see if you can find your P60s, P11Ds, P45s if you've left partway during the tax year. If you have income from self-employment, then having the accounts prepared will be a normal useful input documentation. If it's from property, then rental accounts will be needed. Typically, when the tax return is completed, no supporting documentation is normally required to be submitted at that time, but HMRC reserve the right to come back to you and ask questions. So make sure you've got some backing documentation or evidence to support the information and figures that go into the tax return. In some situations where that evidence may not be present, then a reasonable estimation can be made. Now, when I comment here about assume you will be investigated, HMRC reserve the right under self-assessment once it's submitted to evaluate, comment and come back to you on a specific part of your tax return or all of it. So as you put the information into your tax return, thinking what's the basis on which I put those numbers there. So having that framework is not Now, self-employed, what can you actually claim? If we're self-employed, the tax is based on the profits that we make from our business. That's the difference between what we charge our customers and what our tax allowable expenses are. The expenses that we do claim have to satisfy certain criteria, and one of the main criteria is they have to be wholly and exclusively for the purpose of business. So e.g. if we go on holiday to recover from a stressful period in running our business, even though it's essential to the business health, it's not allowed as a business expense. You can claim under what's called a simplified expense regime, which is dealt with on a later slide. So effectively think of these as scale rates as opposed to the actual costs. Now, we said at the beginning about wholly and exclusively. By nature, some items that we spend money on in our business are for personal as well as business reasons. So a typical example would be the mobile phone or our motor vehicle, where we use those items partly for business, partly for personal. HMRC by concession allows us to claim the business proportion. This rule does not apply to companies, by the way. If we're travelling to see a client by whatever mode of transportation that we actually adopt, then we can claim the expenditure in respect to that mode of transport. Training. Now, if it develops or enhances our existing skill sets that we're using in our business, then these are normally allowable. If, however, your training is on acquiring new skills or qualifications that we didn't originally possess, then that tends to be disallowed. We can also claim for using our home as an office, or where the majority of the work that we do is carried out. So it could be a back bedroom, it could be a dedicated space in the office. Entertainment of clients and suppliers, however important those individuals and companies are to our business is not normally permitted. Work-based clothing such as steel toe caps, embroidered or branded workwear is permitted. General purpose clothing tends to be disregarded. Now, legal and professional costs, for example, renewing a lease, taking a naughty client to court for non-payment of bills, accountancy fees for accounts preparation is allowed. Now, I mentioned on an earlier slide something called simplified expenses. Now, if our business has sales below the VAT registration limit, currently 85,000, then HMRC allows us a choice of claiming certain expenses based on their actual cost or actually using scale rates. This is known as the simplified regime. Now, a bit of a devil in the detail. The simplified regime only applies to sole traders and partnerships. Limited companies, even if they have very modest turnover, cannot use this regime. In respect to vehicles that we're claiming this on, working at home, we need to keep a record of business mileage that we've travelled and hours that we have worked at home. So again, it comes back to an earlier comment about evidence. The three main areas that the simplified regime will apply to is using vehicles, working at home, and what's called work-live premises, for example, a B&B type arena. Now, if it's for a vehicle, the simplified regime allows us to claim a flat rate, 45p up to 10,000 miles of business travel, 25 pence per mile thereafter. Motorcycles, 24 pence per mile. Bear in mind, by the way, when it comes to claiming these, you can't chop and change each year. You can only change once you change the vehicle. When it comes to the use of home, typically the simplified regime allows you to claim a scale rate, and it's based on the number of working hours at home. So to the extreme, 101 plus hours working at home on your business, whether it's marketing, preparing the accounts, continuing with your social media feed, etc., then you can claim £26 per month. Now, on occasion, we will make capital purchases. Accounting people call these fixed assets. And effectively, these items are ones that we retain in the business, and they are effectively part of our infrastructure and help us carry out what we do. Typical examples that you're going to come across are things like computers, motor vehicles, vans, equipment, and that could range from books if you happen to be in the service industry to traditional equipment that we use in the running of our business. Bear in mind how we use those items for accounts preparation is not the same as we use for tax rules. So under the tax rules here, subject to the amount that's being spent, we can claim the entire cost of that purchase through something called the capital allowance regime. It, however, remember, may not always be advisable to claim the 100% of the cost, subject to what your income is. So if your profits and income are relatively low, that will be covered by the personal allowance. You may not necessarily wish to claim capital allowances. Coming into our penultimate slide, let's have a look at some of the key dates within the self-assessment regime. Now, if we're not already registered for self-assessment and we have a source of income that's not been previously notified to HMRC and it exceeds £1,000, then we must inform them and register from the 5th of October following the end of the tax year in which it arose. Failure to do so, by the way, can potentially put you under a penalty regime. The There are two ways to submit your return. You can either do it in paper form. The deadline for that is by midnight 31st of October 2018. Online you have until midnight 31st of January 2019. When it comes to the payment side of things, if you have PAYE income and other taxed income, if you wish the payment to be collected via your tax code and it doesn't exceed £3,000, then get the return in by the 30th of December 2018. Any tax that's owed for 17/18 plus any payments on account must be paid by the 31st of January 2019. A payment on account typically will be due if the tax we owe is over £1,000, and this payment on account is effectively an instalment towards next year's tax bill. We can make a claim to reduce these payments if we anticipate the next year's income will be lower than the income that we're completing for. The second payment on account, by the way, is due on the 31st of July 2019. Now, having done all this, you may then discover that you don't have the funds to pay the tax, or the tax that's owing is a bit of a shock to the system. If this does happen, what we advise all our clients to do is don't adopt the ostrich stance. And don't delay submitting a return because you feel that the tax man will be after you straight away. You can negotiate typically with HMRC a time to pay under an instalment regime. They will, however, not discuss this with you until your tax return has been submitted. In our experience, it's highly unusual for HMRC not to agree to a payment proposal of some description. Bear in mind, if we don't enter into this negotiation, if we don't make an arrangement with HMRC, they do employ a number of external debt collection agencies who can vary between very cuddly, unlikely to very assertive. I just want to mention here at this stage the headline rates for 17/18, so you're aware of them. Personal allowances: an individual can have income up to 11,500 and not pay income tax. And there's also the ability for a married couple or same-sex relationship to transfer unused married couples allowance. The rates for income tax: 20% up to £33,500 worth of taxable income. If the income is over 33.5, you pay 40% and you're called a higher rate taxpayer. Over 150, you pay an additional 5% supplement. Dividends: after the first 5,000 of free dividends, you pay tax at 7.5%, 32.5% on the excess. Now, sometimes what's missed out is national insurance is also due. 9% between 8164 to 45, a 2% supplement on top if it exceeds 45,000, and you have what's called a flat rate national insurance, which is £148.20 if your profits exceed 6,025. And lastly, if you do have any capital transactions, what we mentioned earlier on, the property disposals, the share disposals, and they're taxable, you have an annual exemption separate from the personal allowance of 11.3. The rates you pay are dependent on whether you're a basic rate or a higher rate taxpayer. So it can go from 10 or 18 if you're a higher rate. If it's residential property that's been the source of the capital gain, then it's 18 as a basic payer, 28 if you're a higher payer. Now, thank you for your time and attention. My name is Mahmood Raza. I've done this presentation. I'm the proud owner of Proactive Resolutions. If there's anything you feel we can help you with, please by all means contact us. The email is info@Proactive Resolutions. Feel free to visit our website, and many thanks for your company today.